Hello and welcome. You're watching the Small and Mid-Cap Show. I'm Hiral Dadia, and with me is my colleague Hersh Sayta. Good morning, Hersh. Clearly from a market's perspective as well, slightly subdued in today's day of trade. A couple of stocks we are watching out for in today's session is a TCI on the back of earnings. You have a GHCL that will be in focus as well in today's day of trade, and a Bank of India. So three managements for all of you to watch out for. But let's quickly look at a TCI and see what the company is doing in trade. 5% up move coming in today's session on the back of the numbers. Overall, if you go to see revenues, a growth of around 3 to 4% coming in there. Margins have seen a dip, and the profit number has seen a dip also this time around. Let's welcome in our guests to understand what's worked, what's not worked. Vineet Agarwal, the Managing Director of TCI, joins in. Vineet, good morning and welcome to the show. Firstly, in terms of overall numbers, have they met your internal expectations? And what has worked, what has not worked according to you?
Well, numbers have to always be better to meet our expectations. However, there are some, of course, macro challenges. The softening of the core sector, as we know, and some of the manufacturing sectors have also slowed down a little bit in the last 2 quarters. So we've seen that impact on a little bit on the top line, and then consequently a little bit on the bottom line as well. In the last year, at the same time, we had our CVS business that was doing reasonably, actually quite well because of the high freight rates. And we knew that that is going to come off a bit as well. So that has also happened in this quarter. But we are quite reasonably confident about the next quarter. Q4 is usually the best quarter for us because this is a year end for most companies, and there's a push towards sales as well. And we do think that some of the impact that the trickle-down effect of some of the investments that has started to happen, both from the government side as well as from the private side, will see some impact on logistics as well.
Okay. So, Vineet, as you're mentioning that the fourth quarter is going to be your best quarter, what does that translate into for FY24? Would you maintain your top line and bottom line guidance of around 10 to 15% growth on a year-on-year basis? And secondly, where do you see the ROC? Because that is the number that we were looking at above the 20% range earlier.
Yeah. So yes, we would need to modify the guidance a little bit from the 10 to 15% to about 8 to 10% for both the revenue as well as on the bottom line. This is, I think, in line with what we are seeing for this quarter as well. Also, in terms of the overall next year guidance also would be similar at the 10 to 15%, because I think a lot of the pickup will start to happen from now onwards. So I think the EBITDA margins at 10% to 11% is something that we are confident of achieving going forward also.
Understood, Vineet. Hersh also joining in. You've given a slightly longer term guidance of 10 to 15% on top and bottom. Does that change at all?
No, it doesn't, because long term we feel that there is a lot of steam in the Indian economy, specifically because the logistics sector has started to change quite a lot. If we see that there's a shift happening from the informal sector to the formal sector, there is the entire omni-channel experience where customers use online delivery as well as going to the high street. That has changed. We have a cold chain business where there's a lot of, we are seeing development happening. And one of the fastest growing segments that we have in our supply chain business, where we are doing automotive logistics. And that is also seeing a huge amount of growth, not only for this year, but going forward. So yes, longer term, 10 to 15% is something that we will maintain.
Understood. And, if I can try and understand what's happening with regard to CAPEX as well, you've suggested that you've lowered the CAPEX guidance by around 100 crore in Q2 FY24. Are you now on track for the CAPEX or any changes there?
Yes. What happened was that we were in line to buy a ship in this financial year. And that would have meant that, the 375 crore CAPEX that we had started at the beginning of the year would have happened. But then what we did was we placed an order for 2 brand new ships that are going to come in FY25, end of FY25, early 26 calendar year. So that means that we have to pay a certain amount every year rather than paying a bulk at one shot. So which meant that we were able to reduce the capex to 275 crores for this financial year. And yes, we would be closer to 250, 260 crores. And going forward also, FY25 and 26, we'll look at the same amount of capex.
Right. So, Vineet, with the capex number that you're talking about in terms of the remainder of 24 and 25, we're looking at 250 to 260 crores. By how much will it help you increase your capacity? And what's the peak revenue generation you're looking at from that revenue, from that capacity?
So in the logistics sector, it's not like a manufacturing plant that, when you put it up and suddenly you
Correct.
number. But yes, so that's where the impact flows on over the course of the year. So like, for example, the investment that we're making into the ships, we will not see the ships till early 26. So there is no impact on top line or bottom line for that. Definitely an impact on the ROC. But some things like, for example, trucks, as soon as we buy trucks, they come on road right away and they contribute to the revenue growth. We invest into buildings and hub centers and warehouses. They are also a part of the overall business growth. So what we are guiding towards a 10 to 15% top line is what will sort of is really based on this additional capex that we are doing also.
Understood, Vineet. And Vineet, with regard to the Red Sea, I'm tempted to ask, what's the impact like for you?
Actually, for us, not any kind of impact because we operate our ships only on the domestic sectors. We are seeing that the indirect impact is that the fuel prices are slightly elevated, which is on the bunker prices, which is the fuel that you use for shipping. So that's elevated and that has an impact, of course, a bit negative. But since we don't operate on those sectors, we don't see an impact on the freight. But yes, internationally, the freight rates have had an impact, and India is also going to feel a little bit of that pinch with the Red Sea.
Right, so that's with regards to where the Red Sea impact goes. Vineet, running completely out of time, but we will come back to you to have a longer detailed chat. So that's the management of TCI. Clearly maintains a 10 to 15% guidance in terms of top line for FY25. However, the company has gone ahead and reduced the guidance with regards to FY24 to 8 to 10% from a 10 to 15%. So that's a big one coming in there. And the margins are expected in the range of around 10 to 11%. 250 to 260 odd crores is the capex that is planned for FY25 as well. In fact, let's quickly slip into a short break. Next on our radar is soda ash maker GHCL. We will not take a break right now. That's what I'm getting from my producers. But let's quickly pull up GHCL on the screens and see what the stock is doing in trade. 4 to 5% is the kind of cuts that we are looking at. If you see in terms of profitability, a dip that has come in there. Margins have seen a major beating as well. Joining us on the show is Mr. R.S. Jalan, MD at GHCL. Mr. Jalan, clearly, when you're looking at chemical companies specifically, all of them have taken a beating this time around. What has gone wrong?
See, good morning, Hiral. Basically, we are comparing from 22-23, which was a peak period for the chemical business and particularly for soda ash business. However, if you compare the same number with the pre-COVID period, which was a normal year, probably you'll find that our margins are even better than the margin which we have been in that period. So it's a comparison which is basically with the peak period, number one. Number two, basically globally soda ash supply situation has been elevated because of some new capacity has come into the stream in China as well as in the US. However, on the other side, the demand globally, particularly in Europe, as well as in America, has gone down. So because of that, there is an oversupply situation in Europe and US, and that is getting dumped into Indian market. However, Indian demands are remain intact, or it is improving, and therefore, and even I would like to say China, which is the 40% of the global production and the demand, there also the demand is good. So my understanding is this is a period of where, because of the global slowdown in US and Europe, Because of that, this dampness is there in the margin. And hopefully in next few quarters, when the economy of Europe, particularly Europe and US improves, this will come back on a normal level.
And therefore, sorry, Hersh also joining in here. Just wanted to try and understand, Mr. Jalan. So therefore, your realizations will also see an uptick, or these new capacities will impact realizations even in the medium term?
See, Hersh, yes. If you look at the next 1 or 2 quarters, definitely the margin maybe will be in the range bound. However, the prices will soften from here also. But since the raw material prices are also going down, energy prices are also going down, so hopefully our margins will be in the same range bound in next few quarters.
Mr. Jalan, if you're saying range bound in the next few quarters, what range are you looking at, number one? And the second part of it is, how long do you think it will take you to come back above the 30% margin level which we've seen earlier?
Yeah, Hiral, as you rightly said, maybe in next 2 or 3 quarters, probably the margin will be in the same range which you have seen in this quarter. And hopefully after that, the gradual improvement will take place. And as you rightly said, if you look at our longer terms margins, is around 30%. So hopefully next, maybe end of the 24-25, probably the margins should come back to the normal level.
Understood. And so if I can just have a rough breakup with regard to export versus domestic that you cater to, what's the revenue contribution like, just to try and get some perspective there?
See, Hersh, this business is primarily focused on the domestic market because the margins are better in the domestic market.
Yes.
And therefore, out of our total volume, almost around only 5% goes out of the for the global or for the nearby market. Balance 95% is catering to the domestic market only.
But so that gets impacted largely even due to global factors is what we're trying to understand here. Am I right?
Yes.
Understood.
Hersh.
Got it. So, quickly speaking, so next year, probably second half of next year, we'll see a bit of a margin recovery. Where should top line go thereafter? Do you also expect, as realizations start to improve, kick through next year, probably rates also start to come off, you're expecting top line to grow by?
See, Hersh, if you, like you rightly said, if the prices goes up, automatically the revenue will go up. In terms of the volume, we are personally of the view that probably 5 to 7% kind of a production growth will happen next year. And depending upon the pricing of soda ash, the revenue growth will take place.
Right. Mr. Jalan, my last question coming to you is with regards to soda ash prices. There has been a constant downtick that's happening with regards to, in the domestic market as well. Where is it right now, and how do you see the trend going ahead?
See, if you look at the soda ash global, the Indian demand perspective, there's a huge opportunity which is likely to come in maybe after 1 or 2 years. Because as you know that solar investment, Indian government is very focused on the solar investments. And you have seen that in the interim budget, the government has announced rooftop solar in a major way. Even very large players has also announced the green hydrogen, where all these things require the soda ash consumption. So therefore, currently the total Indian demand is around 4 million. In next 3 to 4 years time frame, you will see that the demand of 4 million will go to roughly around 6 million. So there is a huge opportunity of 2 million, which is almost around 50% demand uptake is likely to happen in next 3 to 4 years time.
Right. So that's with regards to where soda ash prices are concerned. Thank you, Mr. Jalan, so much for speaking to us at NDTV Profit. But clearly, from an overall perspective, 18 to 19% is where the margins will continue over the next 2 to 3 quarters. The company can be back above the 30% level only by the end of FY25. Volume growth of around 5 to 7% is what the company is seeing in FY25 as well. China-India demand is improving. It's mainly Europe and America, which is seeing, troubled waters, and that's creating oversupply in other regions as well. But let's quickly slip into a short break. Up next, we will speak to the management of Bank of India. Hersh is in conversation with them. We'll be right back. Please stay tuned.
Good morning, welcome back. You're watching NDTV Profit. We have with us now the management of Bank of India. We have Rajneesh Karnatak, who's the Managing Director and CEO at Bank of India. Welcome, sir.
Thank you so much.
Right, we're going to try to break down the results for our viewers, sir. First off, I want to try and understand what's happening with the margin trajectory. We've seen margins erode by 40 plus basis points over the year, but this quarter has been where the knock clearly is. 23 basis points down, 0.23% lower on margins, now at 2.85%. So two questions: what's causing this impact? And second, where do you see this go in the Q4 as well as in H1 FY25?
Yeah, so there has been definitely some pressure on the margins, as you rightly said, because of the fact that there is a liquidity tightness in the system. And if you see the RBI data also, as on January, the credit growth on a YOY basis is around 20% and the deposit growth is around 13%. So there is a gap of around 7% on the incremental accretion in the deposits. So definitely that is creating some liquidity pressure and the pressure on the deposits, because of which the margins is under stress. So as regards our bank is also concerned, so the margins were in pressure on the sequential basis, if you see from September to December, because there was some high cost of increase in the deposit during the December quarter. But on a 9-month basis, if you see our margins, if you see our net interest income, there was an improvement in the net interest income and the margins on a 9-monthly basis. So margins, we are trying to protect the margins as much as possible. So March 24 guidance, as far as it is concerned, will protect the numbers on the margin side as there were the numbers on the December side. So if you see further, our NIMs were at around 3%, 2.95% on a 9-monthly basis for the global NIM. And for the domestic, it is well above 3.25%. So we'll be able to protect that also. And on the international side, it is also at around 1.25%. So overall, we are saying that we'll be able to protect the NIM for the March 24 quarters, basis the numbers which were there in the December 23 quarter.
Understood. And you're largely attributing this to deposit cost of deposits going up, right?
So just to elaborate on that, if you see the latest data which is there on a AAA NBFC, when they are raising fund, a 1-year fund, the cost has gone up to as high as 8.6%. For a AAA NBFC on the corporate side, the 1-year CP is going at around 8%. On the CD side also for the banks, the 1-year CD is going around at 7.9%. So clearly the cost is going up because of the tightness in the liquidity in the system presently which is there. But we do not foresee this liquidity to be there once the March is over. So the Q1 of FY25, there should be more softness in the liquidity and softness in the rate of interest also. So what we feel personally is that the rate of interest, whatever it is, has plateaued now at the level of December, and it would continue to remain at this level till March, after which it would soften.
Understood. So if I can just round that off by asking you, your cost of deposits now have, or your deposits now have largely been repriced fully, and therefore you are quite comfortable with regard to this margin being stable. Is that the best way to put it?
Now the deposits have all got repriced. If you see our franchise, if you see the data for Bank of India, so on the domestic side, 44% of our deposit is CASA deposit, which is CA and SA, and the remaining 44% is retail term deposit, which is as per RBI guidelines up to 2 crores. And we have bulk deposits of only 12% of our total domestic deposits. So that way, whatever is cost of deposit for us as on December is more or less repriced, and the cost of deposit should normalize now and stay at the same level. I would not say that it would go down, but it would stay at the same level for Q4.
The other piece I want to try to bridge is to try and understand where your OPEX currently stands at and where should it go from here. Was there a largish impact one-off this time around with regard to a provision for wages? Is that what has caused the knock on OPEX? Could you give us some perspective there?
Yeah, if you see our operating profit, we have touched 3,000 crores of operating profit in Q3 this financial year. So sequentially it has come down, and from if you see on a YOY basis also it has come down. However, if you see our 9 months numbers, our operating profit has improved by around 14%. So as regards the reduction in the operating profit of this quarter, basically there are two items in it. One item is with respect to, as you rightly said, on the wage revision side. 483 is the provision which we have done in this quarter for the wage revision, which includes a wage revision incremental of 2% from April till December, because we were providing at the rate of 15%. So now since the MOU has been signed at 17% for the wage revision, the incremental 2% we have provided. That is one piece. The other piece being the provision for the Q3 on the wage revision side. So aggregating 483, which also includes the pension provision. So this is a one-off item which has been provided in this quarter, 483 crores. Apart from that, around 380 crores of provision has been done with respect to depreciation in the investment which has happened in one of the performing investment, which is with respect to the resolution which has happened in one of the NPA NBFCs. So there are 2-3 accounts in that. So that is around 380 crores. So total being around 800 crore plus. So being this one-off item, if you add back 800 crores to the 3,000 crore of net operating profit which we have made, so we come back to the 3,800 crore level of the operating profit. So this being one-off item, there should not be any much of pressure in the Q4 coming forward. As I said earlier also, we have improved our operating profit on a 9-month basis by 14%.
Right. With that, thank you so much, sir. Mr. Karnatak, it's been a pleasure speaking with you. But with that, we're completely out of time on this edition of the Small and Mid Cap Show. Of course, stay tuned to NDTV Profit. We'll get you all the news first. On the other side, we have more, with regard to companies. Stay tuned to NDTV Profit.